Markets Live. Welcome back. So excited to have Dr. Alan Ellman, the president of the Blue Collar Investor, here with us today. Dr. Ellman, how are you doing today?
Morning, Howard. Always great to speak with you. Doing good.
Awesome. Glad to have you here. And you're going to talk about a strategy that I've been looking to get a little bit more knowledge about personally, and that I'm trying to learn. So I'm excited to listen to what you have to say today. And you're going to talk a little bit about the put, call, put, or the wheel strategy, right?
Yes, the most people refer to it as the wheel strategy. I like put, call, put, or PCP because it's more descriptive of what we're doing. In essence, it's a multi-tiered option selling strategy where you're using both selling cash secured puts and covered call writing.
Oh, so we do both in this case. Okay.
So what I thought we would do, Howard, is to, briefly define the two strategies very briefly, give you hypothetical examples, and then we'll get into a real life example with T-Mobile and
Perfect.
kind of make everything come together. So PCP, or the wheel, starts with selling an out of the money cash secured put. So that means agreeing to buy the shares at a lower price than they're currently trading for. So when we sell cash secured puts and we sell put options, and they're called secured because the broker is going to require us to put a certain amount of cash into our cash account if that trade is in fact executed. In other words, if the option is exercised and the shares are in fact put to us. How can we afford to buy them? Well, the cash is in the account, and that's why it's called cash secured. Now, how much cash do we have to put into the account? The formula that you see on the screenshot in yellow, you take the put strike, the amount you're agreeing to buy the shares for, deduct the put premium, multiply that by 100. That's one contract. If you're selling more than one contract, you multiply it by how many contracts you're selling. So to summarize that, we're getting paid to undertake the contractual obligation to buy the put buyer shares at a price that we determine, the strike price, by a date that we determine, the expiration date. So we set the parameters of the put contract.
Okay. And unlike when you're doing the call strategy, covered call writing, this is not covered like you were saying. So you're actually using your cash as opposed to shares to secure this trade, or to I guess fund the trade almost.
Yeah, absolutely right, Howard. In other words, when you're doing covered call writing, you buy the stock or ETF first, and with the put, when you sell a cash secured put, you're securing that put with cash. So in one case, you have to put cash into your account. In the other case, you have to buy the shares first.
Okay. I do see you have a
Okay, so
preview
here's a
example.
preview example. We're starting now with the cash secure put. That's the first step in PCP or wheel, is you sell an out of the money cash secured put, the strike lower than current market value. So let's assume we have a stock, BCI we'll call it, trading at 75. So we're going to look for a put strike lower than 75. That's called out of the money as it relates to puts. So let's say the 72.50 out of the money put strike generates a bid price of $2 per share. We're talking about a 1 month expiration. So for the one contract, for every contract we sell, we're generating $200 less some minuscule option commissions, which is not even worth mentioning. Okay. And so that's our starting point. Now, how much money is the broker going to require us to put a set aside in our cash account? Well, remember I said it's the strike, in this case 72.50, minus the premium, $2 times 100. So that's 7,050 per contract. That's how much cash we have to set aside in our account to then secure that put. So we are basically generating $200 for every 100 shares of contractual obligation to buy those shares.
Okay. And one question I'll jump ahead here is, I am assuming that you would never exercise these before, sort of the expiration date.
Well, most, unless you're looking to purchase a stock at a discount. Okay. And by the way, selling cash secured puts, and maybe this is a topic for another time, but selling cash secured puts is a wonderful, wonderful way of buying a stock at a discounted price.
Right.
Because in this case here, look at the break even, it's 70.50, and the price and the stock started out at 75. So if it's exercised, let's say you said to the broker, you know what? If BCI goes down to 71, I'm in. Here's $7,100 to buy 100 shares. If that happens, well, if it doesn't happen, well, that $7,100 was twiddling its thumbs in your cash account, doing absolutely nothing for you.
Right.
But if it is exercised, then you do in fact generate the price that your target price, 71. In this case, a little bit less than that. So either you get paid not to buy the stock, or you get it at your target price.
Absolutely.
So, but you're right. You don't exercise it. Your goal basically is to generate cash flow or buy a stock at a discount. Those are the two scenarios that can occur with this aspect of the PCP strategy.
Absolutely. It's interesting because it's one that I'm looking at now as I'm seeing a lot of stocks that are approaching down to their 200-day MA that I'm interested in maybe buying at that level for a bounce back from that. This wouldn't be a bad way to start that process, maybe.
Well, it gives you extra downside protection if you sell an out of the money cash secured put. But if you're looking to buy the stock, then you might consider writing a covered call on it. We'll get to that.
Yeah.
So let's continue this example here where the stock was trading at 75. We sell the 72.50 put at $2. So what's our initial return? Not necessarily a final return, but what's our initial return? Well, we're generating 200. We had to set aside 70.50 in cash. That represents a 2.8% 1 month return. And if you wanted to just get a frame of reference to annualize it out to compare it to other investments, that's 34%. Once again, that doesn't mean you're going to end up with that, but that's our starting point.
Sure. It's not a bad starting point either, I would point out.
No, it's not, and neither is covered call writing.
Yeah.
Because on both strategies, you're lowering your cost basis. And that's
Absolutely.
the reason why it puts us in a position to beat the market on a consistent basis.
Absolutely.
So Howard, there are two main exit strategies. You know from the book that you have of mine that there are, I'm getting,
Yeah, hold it 1 second here. Let me stop and we'll come right back. We'll have you start that again. So hold it 1 second. It switched off my headphone for some reason. So I'll cut it and paste that. Come on, connect. Okay, let's try that again. So we'll start right off with you going into the scenario. So hold it 1 second. Let me make sure everything, yeah, it's still there. Okay. So I'm going to go back just to look and then I'll prompt you in 1 second here. And that's not a bad, percentage right there. That 34%, just to start off there isn't a bad place to start.
Absolutely, because when we sell options, whether it's cash secured puts or covered calls, and both, we're lowering our cost basis. And that's the reason why we're putting ourselves in a position to beat the market on a consistent basis. Now, after we enter the trades, Howard, there are two possible major outcomes. Now, we are setting aside exit strategies. And as you know from that exit strategy book that I sent to you, there are, for puts, way over 10 different exit strategies
Sure.
that we have opportunities to better our return. But we're going to set those aside and look at the two major outcomes. So let's assume now in the first major outcome that the price of the stock remains above the out of the money cash secured put strike. So remember, the stock started 75. We sold the 72.50 put. Let's say it stays at expiration above 72.50. Well, that means that the option is going to expire worthless because the put buyer is not going to exercise that option and sell shares to us at 72.50 if they're trading at market at a higher price. It's not going to
Yep.
happen. So what happens? The option expires worthless. We have generated our 2.8% 1 month return, and that cash is now freed up to secure another put for the next contract cycle, month or week, whatever you happen to be using. Now, if we go to the next slide, the second possible major outcome is that the price of the stock does in fact move below that 72.50 strike. And once
Right.
again, we take no action, no exit strategy action. We just let it ride, right? Well, what happens then? Well, the option will in fact be exercised and shares will be put to us or sold to us at 72.50. So what is our cost basis? Well, it's the 72.50 minus the $2 premium. So our break-even price point is 70.50. That is the price, in essence, that we're paying for the shares. Now, at that point in time, Howard, we're no longer option sellers. We got to take that hat off, and
Yeah.
we are now share owners, and we put that
Right.
hat on. What can we do? Well, one thing we could do is sell the stock. If the price of the stock is higher than 70.50, well, we have a capital gain. If it's lower than 70.50, we have a capital loss, as referenced with non-sheltered accounts. Or, as we talked about briefly before, we can just hold that stock, which we've just bought at a nice, juicy discount from when we entered the trade. So we can hold that stock for the long term.
Right.
But what we're talking about today, PCP, is we then write a covered call. That's where covered call writing comes into it, if and when our cash secured put is in fact exercised. And so we're going to now move on to covered calls because that means the put side of the PCP is now complete. And we're now going to the next leg, which is covered call writing. So let me briefly define that for your viewers.
Sure.
And that's where we sell call options which are covered or protected because we own the shares. We might have just bought them, or maybe we already own them. But we base our price on current price, not a price that we may have paid 6 years ago. Today's price when we do the covered call trade. So when we write a covered call, we're getting paid to undertake the contractual obligation to sell our shares to the call buyer at a price that we determine, the strike price, by a date we determine, the expiration date. So if we were going to break down the three words in the strategy covered call writing, covered simply means we buy our shares first. We know our cost basis. Call, that's the type of option we're selling. And writing simply means that we're initiating a sell to open order. That's when we go in our broker form, that's what we're doing. We click on options, sell to open.
Absolutely. Took me a while to understand that when I used to see on like Facebook and Twitter, people would put BTO, STO. No idea what it was at the beginning. So it's good to always point that out for our viewers.
Yeah, when you go on your broker platform and you go to options, it's going to say, what do you want to do? So in addition to putting in what option contract you're referencing and what underlying security you're referencing, you also have to let them know what you want to do. So
Absolutely.
here's again a preview example, just like we did for puts. We're going to buy 100 shares of that famous company XYZ at 48. What are we paying? $4,800 per contract. So that's our cost basis. And now we're covered or protected, and we're free to sell the option. Now I selected a $50 strike for calls that's out of the money or higher than current market value. And I'm going to assume a premium of $1.50 or $150 for the contract.
Okay.
Now, Howard, if that underlying security is less volatile than this hypothetical one, the premium would be lower. If it was more volatile than this hypothetical situation, the premium would be higher than $1.50. I picked something reasonable in the middle. All
Okay.
right. So
Makes
if we
sense.
generated 150 on a $4,800 investment, that's representing a 3.1% 1 month return. And once again, as a frame of reference, 37% annualized.
Yeah. I mean, you can see how
So if we
when
can
you
move on, we'll talk about two major.
yeah. I was just going to point
Sorry.
out that what you tend to see also is when you're using these in conjunction, how they add up, fairly quickly. You can, you take those 1 month returns, and then, like you said, it rolls into that annualized down the road, as you make more trades because you're not going to be in the same trade necessarily.
Yeah, and let me just add, based on your comment, is that because I get this question a lot, can we make even more money using weekly options? And the answer is yes, but it will require a little more time and effort. So the right
Absolutely.
expiration date, is not the same for every single investor.
Sure.
I have multiple options accounts. So I have weeklies and monthlies. I have calls and I have puts. What's right for you or for your viewers, they have to determine that. But can you make more money with weeklies than monthlies? Yes, you do very well with both, but you do have that opportunity to make more with weeklies. But I'm showing you monthlies now because that's where most option traders will end up, at least when they start. And so let's talk about the two major outcomes as I did with the puts.
Absolutely.
If at the end of the month, the price of the stock is still lower than 50, remember how it had started at 48. Let's say it never supersedes that $50 out of the money call strike. Well, the option will expire worthless because the call buyer is not going to say, hey, I got this great idea. Let me exercise the option and buy Allen shares for 50, even though they're trading at 48 on market. Not happening. So what happens in reality? The option expires worthless. We've generated a 3.1% 1 month return. We still own the shares. And now we're free to write another covered call for the next cycle.
Absolutely. That's a
The
good.
second comment, pardon? Yeah, that's fine. The second major outcome is that the price of the stock does in fact move up beyond that $50 out of the money call strike, and we take no action to buy it back. Okay, no exit strategies,
Right.
and shares are sold at 50. Where do we stand? Well, we made 150 on the sale of the option plus another 200, so two income streams on the sale of the stock, 48 to 50 times 100. Total return 350 on a cost basis of $4,800, and that represents a 7.3% 1 month. Now, Howard, I have to stop here for a second because I want to let all your viewers know that this doesn't mean you're going to win on every single trade
Absolutely.
that's made. If the price of the stock drops below your break-even price point, which in this case was the 48 you paid for the stock minus the $1.50 premium, 46.50, we start losing money, and that's where our exit strategy skill set kicks in. So yeah, we're looking at this and it looks fantabulous, but keep in mind that not every trade is going to be a winning trade, but most of them will be if you learn the three required skill sets: stock selection, option selection, and position management.
Absolutely, and that's what it is. It's about bettering your odds. That's what I love about your system is that you can tailor it to how active you want to be as a trader, what your risk tolerance is as a trader, and then like you said, it's how do you want to be? How volatile do you want that stock to be? How much premium are you trying to earn? So it really does fit to almost any investor. I really do believe that.
Sounds to me like one day you're going to write a book on these strategies.
No, no, no. I'll
Okay,
leave that to
so
you. I'll just keep reading them.
Howard, this is a graphic representation of PCP. So you start on the upper left where you sell an out of the money cash secured put. Now, that may or may not be exercised. So let's say the price of the stock doesn't drop below that out of the money. Remember, out of the money for puts is lower than current market value. Let's say it does not. Well, if it does not, then the put expires worthless, and we could then write another out of the money cash secured put, and we keep doing that. until such time that the put is exercised. Now, if the put is exercised on the top right, we're going to buy that stock at a discount, right, from when the trade was initially entered. So now we have purchased that stock at a discounted price, and we can write a covered call. Now, let me tell you this, Howard. When we talked about puts, 99.9% of the time, it's always out of the money. That's how we start PCP. But when it comes to the covered call side of things, it could be out of the money or in the money. And I'm going to show you both of those examples and why
Okay.
in the upcoming real life trade with T-Mobile.
Great.
So just keep that in mind that when you do the covered call, it can be both out of the money, which is higher than current market value, or in the money, which is lower than current market value. Now, if that covered call is not exercised, then we still own the shares, and we could then write another covered call, and on and on and on. And then, if and when it is exercised, shares are sold. Now, all of a sudden, we have all this cash in our account, and we could use that cash to then secure another put.
Absolutely.
And on it goes. So cash generation or buying a stock at a discount.
I love it.
Pretty cool, huh?
It really is.
All right, here's a
And
real
like I
life
said,
example with T-Mobile.
is I see it for myself as a way. I tend to get a little too quick to the trigger sometimes, where I say I like stock X. If it hits this level, then I want to buy it. And what this would do for me is sort of hold my thesis in place, if you know what I mean, and say, okay, well, I want to buy again stock XYZ at $10, and I don't want to buy it unless it drops to $10. Like, it actually gives me a way to do that.
Right. You could sell an out of the money cash secured put, which your break even price point will be at whatever your target is.
Yeah.
So if in fact it never reaches that target, well, you can get paid not to buy the stock.
So you say I get
in the
paid for
form
the
of a put
idea. I
premium.
get paid for having a
That's the
thesis. So, you know, it rewards
Exactly.
it would reward
So
my
the downside
patience in
is-
that place. Like you said, there is definitely, you know, there's a component to the cost of holding the money, you know, in the put for that time. But, you know, if my thesis was, like I said, you know, I really like I'm looking at Procter and Gamble is approaching its 200-day MA. So maybe it's something that like that. This is a different way to look at it. So it's definitely one I'll let you know if I jump in on any of them. I'll definitely let you know.
We'll talk. We'll talk. Okay, here we go. Real life example with T-Mobile. This is a screenshot from one of my books, so it's from a few years ago. It's not current, and you can see that T-Mobile at the time was trading at 86.09, and out of the money put means lower strike than current market value. So I selected the 82.50 out of the money put, which had a bid price of 291.
Okay.
All right. So that is our starting point, and we're going to feed that into the trade management calculator, which I've shown you over every single discussion we've had since we started this a couple of months ago.
Yeah.
And here are the entries. We put in that T-Mobile was trading at 86.09. You see that right in the middle there. And we're going to sell the out of the money 82.50 strike at 291. So that's very easy. You got all that information right out of the option chain. Now, the next screenshot will show the initial calculations, and I want to walk you and your viewers through that because this is what the spreadsheet will pull up. First of all, if you look all the way to the left, it will tell us that if taken through contract expiration, it will be a 39-day trade. So that's all the way on the top left there. Now, what is our break-even price point? It's the strike minus the premium. In the yellow cell towards the left, that's 79.59. So if in fact shares are put to us, that would be our cost basis that we would use if we were then to write a covered call, 79.59. Now, if it's not exercised, what have we generated? Well, you could see on the brown cell to the left, 3.66%, which annualizes out based on a 39-day trade to 34.22%. So if it's not exercised, we've generated a 34% annualized return. If it is exercised, we're buying the shares at a discounted price of 79.59, And
Right.
the spreadsheet will actually reflect the percentile discount, which is in the brown cell to the right, 7.55%. That means if exercised, we've purchased T-Mobile at a discounted price of 7.55% from the price at the time that that put sale was originally executed. So those are the two possible outcomes: buying at a discount or generating 3.6% for 39 days. Either one is good. Where do we lose? We lose if the price of the stock is below 79.59 when the shares are in fact put to us. But
Right.
remember, they started out at 86, so
Yep.
plenty of leeway.
What is this number?
So let's assume now, Howard, that shares are put to us at that break-even price point of 79.59.
Okay.
Now, on this screenshot here, what I did was I created two possible scenarios. The top row is the out of the money 8250 call. So out of the money for calls, just to refresh, because it can be tricky for new option traders. For calls, out of the money is above the current price. For puts, out of the money is below the
Right.
current price. So right now we're on the call leg of PCP. So we buy the shares at a cost basis of 79.59 in the brown cells there. And we're going to sell in the top row the 8250
Whoops.
out of the money call strike. And that generated a bid price of, here we go, at 230. Now the bottom row is the in the money strike, 77.50 below that 79.59.
Yeah.
And that generated 4.25 in the green cell. So, first you look at it, if you're relatively new to options, you're going, wait a minute, that 77.50 is way better. It's almost
Yeah.
double the premium of the 82.50 call. But that's deceiving, because if you own the shares at 79.59 and you're agreeing to sell them at 77.50, are we not losing $2.09 on share value?
Right.
That's called intrinsic value, and that must be deducted from the 4.25 to get your actual time value profit, which you'll see in the next slide. So the spreadsheets, the BCI spreadsheets, will do all that heavy lifting for us. You don't have to worry about doing the math and deducting the intrinsic value from the premium. The spreadsheet will do that for you. But
Which
that's
is
the
so
starting
important.
point. And
It,
now
it
if we
makes
can
it
get
so
our initial
important because there are so many people who don't understand all of the components to their trades. And it's something we talk about all the time. But a lot of times it falls on deaf ears. It's important to know all of this information and to know what all the components of your trade are.
Well, yeah, and not only that, but if you have an appropriate spreadsheet, it will actually break it down for you. So in case you
Right.
forget to deduct the intrinsic value, I can tell you over the 18 years that BCI has been in existence, I can't tell you how many people thought they had much higher returns selling in the money calls because they didn't deduct the intrinsic value.
Yep.
And I would tell them, listen, the trade was good, but not quite as good as you thought it was. And I would break it down for them. But
No,
here's actually
that's
the
what I mean. That's
calculations
what this
now. So
program does
once
is
again,
you provide it for people to make it very easy to do this. As you said earlier, it depending on how much time you want to spend, if you were doing monthlies, you're able to spend one Saturday basically, or two Saturdays a month looking at your stuff just briefly.
well, yeah, you have to monitor your trades to some extent, but one of the things that I've done with exit strategies is partially automated. So when
Right.
we sell a covered call, for example, we always put in, and we think about this, Howard. We always put in a buy to close limit order based on 20 to 10%. That's beyond the scope of this particular discussion,
Yeah.
but it can be partially automated. But yeah, you still have to monitor your trades. I like to look at my portfolios at least once or twice a day, but it
Yeah.
is partially automated. So if we look at the initial calculations now, Howard, the top row represents the out of the money call strike.
Yep.
And you can see in the top green cell, because I put the green, the actual time value returns. So for the out of the money 8250 strike, that's 2.9% 33-day return, 32% annualized. So we're really good there in terms of an annualized return.
Sure.
Now, the advantage of out of the money is that we can also make additional cash if the price of the stock moves from that break-even price point up to that out of the money call strike. In this case, an additional, in the gray cell, 3.7%. So when the smoke clears, if we add up those two income streams, best case scenario, we can end up with a 6.6% 33-day return using the out of the money call strike.
Right.
Now, what if it was like concerned about the market, been volatile, it's been bearish, we're worried about a Fed announcement, whatever it is, and you want to get additional protection to the downside? Well, that's when you would use the in the money call strike. And if we use the in the money call strike, you see on the bottom, let's see if we could do this, Howard. Maybe you could put your cursor where I'm talking.
Yep.
On the bottom row, the second and third columns from the left. Okay.
Right here.
So you could see that the spreadsheet breaks down the 2.25 into 216 of time value. That is
Yep.
our actual profit. So the second cell from the right, from the left rather, on the bottom, that 216 is our initial time value profit. The 209 is not profit, that's intrinsic value. But
Right.
it does give us additional protection to the downside because that intrinsic value component will, in fact, lower our break-even price point. You could see where the red arrow is to 75.34.
Absolutely.
So the in the money strike lowers our break-even price point the most, more than at the money or out of the money call strikes. But the time value component, that 216 that you circled initially, that represents a 2.8% 33-day return, 30.97% annualized. So the actual returns are very, very similar, even though the total premium looked double for the in the money. But once you deduct the intrinsic value, it's in fact almost the same. But I want you to take a look at the pink cell in the bottom row in the middle of the screenshot,
Absolutely.
and that says 2.6%. Let me define that for you, downside protection. That means we are guaranteed a 2.8% 33-day return as long as share value does not decline by more than 2.6%.
Yep.
Stated differently, intrinsic value protects time value. So you could see, in addition to the break-even price point lower with the in the money strike, you also have protection of that time value profit, which you don't with the out of the money strike. If share price starts declining, it starts eating right away into that 2.9%. So I know this is kind of a little bit tricky and maybe a little bit intimidating, but if you hear it over and over again, it will in fact become second nature and make
Yeah,
a lot
I
of
like how
sense.
you have it on the
I
chart
just need to
because,
make one
you
more
have it
comment.
right next to it. So it's sort of easy to see. If you choose the in the money, you do have a 3.7% upside potential that isn't there on the in the money call, excuse me. But what you don't have is any downside protection. It's filled in as 0 right here, where you see the 2.6 over here on the bottom. So again, what you do is you make it very easy for someone to take a look at stuff to make their decisions based on the right information.
Yeah, very well said, Howard. And let me just add one more thing to this slide before we move on.
Yep.
On the top in that yellow, I put in that because 2.6% represents protection of the time value profit. But if you wanted to say, what's my protection down to break even? That actually calculates to 5.2%, and that's going to play a role in the next slide.
Okay.
So this is one of my favorite slides. I call the downside protection
Action
on
on
steroids.
steroids.
So
Like
if you remember with the put trade, on the top, you see the red arrow there, Howard. You remember we purchased T-Mobile at a discount of 7.55% when we sold that out of the money cash secured put. Now, if we move into the in the money call trade, if you recall, I just told you that there was 5.2% protection to break even.
yeah,
So if we add up that 755 and 5.2, that comes out, it says 2 months on the top, but in fact, it's 72 days if you add up the 39 and 33. So over that 72-day period, Howard, if T-Mobile dropped by 10%, we still would have made money
Right.
because we had downside protection of 12.75%. And that again hammers home the fact that when we're selling options, we're lowering our cost basis and putting ourselves in an excellent position to beat the market on a consistent basis and many years substantially.
Absolutely. And that's what it is. It's putting the odds in your favor, like we talk about a lot of times. And that's what this does. This system puts the odds more in your favor than just buying. It's less risky, or it is, I don't like to use the word safe when investing, but it is a less risky way to, to own 100 shares of a stock. And like you said, you earn profit on it. You're renting it out. I love using that analogy of it being like real estate, and you're renting it out.
I use that example, the real estate example, because most people are familiar with buying a property and renting it out or rent to own. So when I'm in front of an audience that really has very little or no experience with options, a lot of times I'll use that analogy. Okay, let's summarize. It looks like we've covered everything, Howard. So we have to set a goal. No matter what strategy we're using, we have to set a goal. How much are we looking to generate? Otherwise, how the heck are we going to know how to structure our trades, right?
Absolutely.
So in my case, if I'm doing monthlies, 2 to 4 a month, weeklies divided by 4. We've said that a few times here. So you just fill in the blank. There's no right or wrong for everybody. It varies from investor to investor. I have a lower goal in my mom's account, 1 to 2%. So it depends on how much risk you're willing to incur, and then you can go from there. So you'll know how to structure your trade. So first start off by selling the out of the money cash secured put. Now, of course, when we're actually doing it in real life, we will be implementing exit strategy opportunities when they come around. They don't always come around, but when they do, we should jump all over it, right?
Absolutely.
And let's assume now that it's on exercise, so you sell another cash secured put, keep on doing it until it's exercised. And now you're on the covered call writing leg of PCP, where you could sell either an in the money for additional protection or out of the money to structure a trade where you could possibly have 2 income streams. Once again, manage with exit strategies if indicated. If it's not exercised, you own the shares, write another covered call. And if it is exercised, shares are sold, freeing up the cash to then secure another put. And on and on and on it goes.
Fantastic. So I have to ask, Alan, do you do you use this more in a bearish market, bullish market? Doesn't really matter, versus just buying your stock as your first, as choice number one?
I would favor this in a bearish market or a volatile market because you're not buying the shares right away. If you end up buying the shares, they're going to be at a dramatically lower price point than when you initiated that trade, that put trade, which would have been a covered call trade.
Right.
So you're getting a little additional, like that slide I showed you.
Yeah, that's what I looked at. It's like I'm making money before I even get into the trade almost. And if I don't, I'm getting paid for the thesis that never came true.
You are making money when you enter the trade. However, it comes with a contractual liability.
Right. There's risk. If it drops, if it's Bitcoin and it goes down to 70,000, you're in trouble.
Right. So, I always avoid earnings reports because that's one of the reasons why stock might drop dramatically if the earnings report disappoints. I always avoid those. And I always avoid securities that have a very, very high implied volatility.
Right.
And so those would definitely, by definition, mean more risk. So again, we have so many members of BCI that align with me, but there's also a lot that are more conservative than I am, and a lot that are more aggressive than I am. And I respect all of them. My way of doing it isn't the only way, but it is right for me.
That's what's important. It's choosing the system or the way to adapt the strategy that works for the individual investor, like you said, because I could see this being played a lot of different ways. Like I said, where it could be more aggressive, where you could be more aggressive with it based on certain things, or more conservative based on different times. That's what I've found about your system as I learn more and more about it on a weekly basis. And that's why I asked if there was one market versus another, because this seemed to me to be a better setup in a, like you said, a little bit more of a volatile or a bearish market, if the market like it was a few weeks ago is taking off, you're not going to, you're not going to make enough premium probably on selling. What it is, what I love is you don't even have to tell people that, because if they're using your systems and your calculators, it's going to rule out the stocks that don't fit the criteria, so to speak. If that makes sense.
Yeah, it does make sense because, we only use stocks that are elite performance from a fundamental perspective. I mentioned to you, and what about previous talks? Those are the stocks that the institutional investors just love.
Yep.
I'm talking about mutual funds, hedge funds, banks, insurance company. They love stocks that have great earnings growth and so on. And so if they love them, I love them. And so we start out with our screening with fundamental analysis. Then we move on to reading a price chart for trend and momentum. And then we do other things like minimum trading volume, diversification, cash allocation.
Absolutely.
So if you use the screening process properly, you're going to start off with a really elite performing security, because in order to get on our watch list, they have to be. Otherwise, we send them off. We have no loyalty to any of these stocks.
Yeah.
So yeah, and then of course learning what strikes to use, which are the strategies. You can integrate them both with PCP, and then how to manage your trades. So yeah, it takes 3 to 4 months for the average investor to be ready to get going if they know little or nothing about options. Give yourself 3 or 4 months, really dedicate yourself to learning this, and then you got years and decades to benefit.
Absolutely. Dr. Ellman, I want to thank you again so much for coming on weekly with us. You provide so much information for investors, and we are trying to lower the cost of, entering trades for our viewers, or trying to get them on an equal footing with the institutions. We're not always going to have all of the bells and whistles that they do, but like you said, is you're already starting off and screening the same way that a mutual or private equity would, to decide what they're going to invest with. And then quite honestly, is you are teaching people a lot of the tools that they use. I'm, as in our world, where our friends are in these worlds of private equity and hedge funds and family offices. And this is exactly the strategies that they use to get those performances that outperform the market.
Yeah. So yeah, and that's what I want for your viewers. The same thing I wanted for me and my family and for everybody following BCI is understand how to structure your trades and how to manage your trades, because there are very few advisors, very few, that know how to manage a trade. And it's going to be very difficult for them to actually manage these trades the way we can manage our own trades.
Right.
And nobody cares more about our money than we do, except maybe our kids. But other than that, so yeah, and so that's the information that we're providing and that you're sharing on Quasar with your viewers, is giving them the opportunity to being able to manage the trades, at the very, very least, to be able to evaluate what their advisors are doing for them.
Absolutely.
That's the very least. But if you have an inclination to do it yourself, you're so much better off.
Absolutely. Well, thank you so much. Have a fantastic holiday. We won't see you again till after the first of the year. So you have a great new year, and we will see you in a couple of weeks, Miss Dr. Ellman.
Always my pleasure. Thank you, Howard.